5 in the chat. All right, Ray, what we looking like?
Looking good.
All right, cool. All right, everybody. So today we're talking about time frame analysis, and this is basically going to help you to determine how to look at time frames for intraday trading versus swing trading. So first and foremost, a disclaimer, I am not a financial advisor, and this is in no way financial or trading advice. I am simply sharing options trading strategies that I use and have been successful with in the stock market. This presentation is for entertainment and educational purposes only. There are significant financial risks involved with trading, and I am not responsible for your losses in the market should you decide to utilize the information and/or strategies discussed within this presentation. By choosing to proceed, you are acknowledging your understanding of this disclaimer. So I'll go ahead and let Ray introduce himself.
All right, I'm Ray. I'm a father of two. I'm a trading admin. I'm into calisthenics. That's all I got. That's all I can remember.
All right, thank you, Ray. And about myself, my name is Kayla. I go by iCurly K on Instagram and Twitter. I'm a mother of one. I am an executive account manager, a recent cosmetology grad. I am an options trading admin, a Florida resident, and a yogi. All right, so the goal for today is to help you understand the purpose of using smaller time frames and larger time frames. So larger time frames allow you to see the bigger picture. Smaller time frames allow you to see all of the fine details that make up the bigger picture. Zooming out too little will cause your smaller and seemingly larger time frame to look almost identical, which doesn't help to give you any new information for your trade. Zooming out too much will give you irrelevant information that is unnecessary for your trade. There has to be a balance between your entry time frame as well as your higher time frame. So for intraday trading, which is basically taking advantage of trading opportunities that happen within the day, so the current day. Now, if you look at the 1 hour chart, this time frame allows traders to find key levels of support and resistance zones or supply and demand zones. This will give you the strongest levels based off of previous data that is needed to intraday trade. Then what you would want to do is zoom into the smaller time frames like the 5-minute or the 15-minute chart to get a good entry. Now, here are some pros and cons of the 1-minute and the 5-minute chart. The pros is that it will give you faster buy and sell signals, and it's more viable for the first 15 minutes to an hour. The cons is that these timeframes are a lot less directional, and there is a lot more choppiness on the chart because it's on a shorter time frame. And it is not the most accurate when determining the overall direction of the trend. And just to veer off from this slide just a little bit, you have to think that each candlestick on the 1-minute or the 5-minute chart is going to represent 1 minute or 5 minutes. So let's just say you were looking at a 1-minute chart. You are going to see so many different directions because those are happening on smaller time frames. So on 1 minute, it could be a very bullish candle. The very next minute, it could be very bearish. So that will cause a lot of impatience when trading. So it's not really good to look at those extremely small time frames because it can scare you out of your position. So the 15-minute pros and cons. The pros is that the 15-minute chart gives you a more accurate perspective to the big picture. Also, key levels like support and resistance are easily identifiable on the 15-minute chart. With the 15-minute chart, traders are more patient and less likely to receive false buy and sell signals. Now, a con would be you have to rely more on confirmation of the trend from indicators because waiting 15 minutes would give you slower buy and sell signals. So for swing trading would be taking advantage of trading opportunities that happen over the course of more than one trading day. So keep that in mind. Now, I threw this in here. There is a book by a man by the name of Dr. Alexander Elder, and he created something that's called the factor of 4 to 6 in order to assist traders in looking at the most important timeframes on a chart based on their entry time frame. So first, what you would do is identify your entry time frame. So for example, if you're entering off of the 1 hour, then what you would do is you would multiply 1 by 4, which is going to give you 4 hours. Or you would multiply 1 by 5, which is 5 hours, or 1 by 6, which is 6 hours. So it's the factor of 4 to 6. So you're basically multiplying to see how far out you need to look in order for it to be relevant to the trade that you're trying to take. So for example, if you're trying to enter on the daily time frame, then 1 week would be the highest that you would want to look out or use to look out for your trade. If you're entering on the 1 week time frame, then your monthly time frame would be your higher time frame, if that makes sense. And I just want to do a quick temperature check. If you guys understand that part, please put a 5 in the chat. Ray, let me know what's up.
All right, I'm seeing mostly 5s.
Okay, cool.
Hold on, it might be 1. It's like two sad faces. So
We'll circle back around to it, but if the overall sentiment is 5s, then we'll circle, and then also this will be in Wells Square University as well. Okay, so what to look for on the higher time frame? On the higher time frame, you are looking for the current trend, not the overall trend. You're looking for the current trend. The reason why is because the overall trends could be bearish, and then if you go over and look at the shorter time frame, it may look bullish. Keep in mind, you're not trading the higher time frame, you're trading off of your entry time frame. Now for swing trading, you can start by looking at the weekly chart, then the daily chart, then the 4-hour chart. If you're like me, to be honest with you, when I swing trade, if you guys were on for the very first part before we even started getting into the lesson, you'll see that I personally like to look at the 1 year, 1 month chart. And I like to draw out my supply and demand levels or my support and resistance levels, because I know that on the longer time frames, those support and resistance are areas of value. They're stronger levels. So you might want to look at the overall picture. That may be something you want to do, but when you hone it down and you're looking to actually swing trade, depending on how long you plan on holding, you don't want to look too far out. So it's important to start from a higher time frame so that you don't miss any strong key levels of support and resistance, and then begin to work your way down. Now you can think of this as looking at a diamond with the naked eye and then taking out a loop to inspect all of the fine details. And this right here would be what a loop is. And I know you guys have probably seen people, inspecting diamonds to see the fine details. That's essentially what you're doing when you look at the larger time frames and then you scale down to smaller time frames. Now, a quick tip. After current resistance is broken, it is now a new level of support. After a current support is broken, it is now a new level of resistance. The more times price action touches either the support or resistance, the stronger that level becomes, which is why the implied move is often greater. Once price action breaks through those very, very strong levels, that's when you see the price action begin to rocket. And if any of you looked at the trade that I called out when I called out HD the other day, I was able to say that if it blows through this particular level, because it's such a strong level, the candlesticks have rejected this level so many times that the moment that it actually breaks through this level, that means that it is going to fly. So hopefully that helps you to get, a visualization of how it actually works. So areas of value, what to look for. So you want to look for areas of confluence, which is basically levels of support and or resistance that are both respected on both entry timeframes, basically the higher and lower time frame. This makes it a significant level. These are levels that you would want to be trading off of because they are high probability setups. So if you're seeing a key level that's respected on the higher time frame and the smaller time frame, please make a mental note of that, because that is a very significant level. You also do not want to buy when the price action is too far from the area of value, because it's a significant level on the higher time frame. For this, what you would want to do is actually draw out a channel using trend lines around the price action. Also, check to see what moving average the price action or candlesticks are respecting. And when we say respect, we basically mean which one does it normally pull back to? Which one does it normally ride off of? That is an area of value. You always want to buy when it pulls back to that moving average, not when it's too far away from that respected moving average. Now, what should you do when multiple time frames are in conflict? You want to isolate any higher lows or higher highs, or any lower lows or lower highs on the longer time frame. You also want to identify the price action or candlesticks, whether or not it's above the 200-day moving average, which is considered bullish, or if it's below the 200 moving average, which is considered bearish, especially if it happens on both time frames. If they are still in conflict, you can wait for both time frames to align. And you hear us say full time frame continuity. Well, this can kind of give you an idea of what that basically means. You also want to be extremely conservative with your target profit percentage. So if you decide, okay, I see on the larger time frame, it's conflicting with the shorter time frame, again, you're trading off of your entry time frame. So what you want to do is stick to that if you do decide to take the trade, if it's in conflict, and you want to be very conservative and moderate with your target price profit percentage. Do not get greedy for these particular trades, and use a shorter time frame, again, the entry time frame, so that you are not working against the longer overall trend. All right, so that is the end of the time frame analysis, and we can open it up now for any questions. And again, you guys, as always, when we do these classes or lessons rather, you do not have to stick to the topic at hand. If you have any questions that you want to bring, it doesn't have to be about time frame analysis. Go ahead and ask your questions, okay? And while you guys are answering or asking your questions, Ray, I'm going to switch back over to my chart. They can stay on the chart with me. We don't have to switch back to just nothing. They can actually stay on the chart with me.
Okay, cool. Yeah, so if you have a question, raise your hand. So the first question, go ahead and be Malcolm. All right, Malcolm, you can go ahead and ask your question.
Hey, Ray and Kay, I just want to say I appreciate you guys doing this. My question is, I'm wondering on the I guess it would be FinViz or any stock screener, how you find stocks, particular stocks that would be good to look at to trade for the day or whatever time period you're using.
Hi, Malcolm. So I personally use FinViz. And so first of all, do you have any particular indicators that you like to use or any setups that you like to use?
Sorry, I muted myself. So to be honest with you, I don't use them at all. I mostly go with the places you guys call out, but you know, I'm realizing that I need to start doing my own due diligence, which I do once you call them out, but I need to start trying to find my own particular stocks. So I just want to, I guess I'm just asking it as like brand spanking new to finding my own stocks.
Okay, so I do actually cover, and I am going to say this, I do actually cover FinViz in my course, but this is something that I like to do when I'm on FinViz. If you guys, Ray, can you see my screen?
Yeah, I can see it.
Okay, so just a simple run through of FinViz, because it's very in-depth when you actually look at FinViz, but I can just show you some of the things that I like to do. But for the sake of time, I'll just let you know that I do cover this in my course. But you can obviously, and I'm going to say this too, you can obviously find, a lot of good information if you Google or YouTube how to use FinViz. But I just wanted to let you know that that's something that I offer as well. So anyways, for example, if you're going to do like your market cap, you have to figure out like what size market cap you want to trade within. You have the opportunity to switch it over to large, which is something that I like to play around with. I don't typically mess with the earnings dates because I don't play earnings, but let's say you're somebody who, actually trades earnings. You have these options here. You can trade something that has earnings within the next 5 days or this month or tomorrow. You can select any of those particular filters. You may want to do average volume, maybe 1 million. You obviously want the volume to be there. I normally play around with 1.5 or 1 for the relative volume. You can actually play with the float. You can do analyst ratings if it's a buyer, better if you're looking to go long, or if you're looking to short the stock, you have your options there. You can play around with the industries that you want to, trade within. It's a lot of good things that you can come over here and do within FinViz. And obviously, if you're trading options, then you want it to be optionable. You also select the country that you live in, however you decide to trade it. You can also play around with the price action here. And then one other thing that I want to show you guys, I know a lot of people ask me where I got the chart from, that little heat map chart. Well, I get it out of FinViz. Whenever I'm trying to see what the sentiment of the overall market is, I just come here. So this is basically how you can use FinViz to your advantage. And then, of course, you can come here and you can look at Taiwanese companies and Chinese companies over here. Obviously, like TSM is a Taiwanese company, BABA is a Chinese company. It's a lot of things that you can do. But this is one good way to utilize your stock screeners.
All right, excellent. Yeah, it looks like I'm gonna have to go ahead and get your course, because that mostly went over my head. But I appreciate you guys.
I tried. I'm so sorry.
No. Cool. I'll get that. I'll get your course.
Again, I don't want you guys to think that you have to. I laid out a list of everything that's covered in my course, and it's just to accelerate you so that you don't have to bounce from area to area to find what you need. So obviously, again, I just want to say, because I'm very passionate about people learning, and especially those of you that are in the Wealth Squad, I knocked it down to $25 and I left it there for you guys because you're family, and I did that for a reason. But again, you may be able to find this information. You're just going to have to bounce around from place to place to piece it all together. So you just have to figure out what's convenient for you.
No, for sure. Don't worry. You'll see my money soon. Thank you, though.
No problem.
Real quick before the next person, somebody had asked in the chat, what do you mean it's more viable for the first 15 minutes or hour? So whenever you had said that in your presentation, if you could go back over
it matters most within that time frame. It's only more helpful within that time frame.
Okay, so hopefully that answered that person that asked it in chat, because I didn't want to miss their question. All right, Homer, you can go ahead and ask your question.
Hey, how's it going, y'all? Thanks again for everything y'all do every single day. You guys are great.
Thank you.
So I was actually looking at Gerald Peters' presentation earlier, and he was talking about something with the full moon and the boxes. And I was just wondering if you guys had heard about that, if you guys incorporate that into your trading strategies, the full moon thing, or the boxes.
Ray, do you incorporate the full moon? I don't incorporate the full moon. I do understand his boxes. He's basically talking about an accumulation or a consolidation period where the stock is basically trading sideways. But those are like his particular strategies. I encourage everyone, even this morning, I sent out, a message to everyone in the community to hop on to Gerald Peters Live so that you guys can see what he's talking about. So my recommendation would be just to catch up on his YouTube channel, and he'll break it down for you, so that you can understand exactly what he's talking about. But Gerald Peters is great. So the box is basically when you see, if you can see my screen, it's basically when the price action is just trading sideways within a box. That's basically what it means. It's in an accumulation phase. It's trading sideways. Either there's going to be a breakout to the upside or the downside. And so for what I'm looking at right now, I'm pretty much feeling, I'm bullish on this particular stock, but that's what it means. It means that the price action is trading sideways. It's trying to figure out a direction to go in.
Are you saying that because it's bouncing off of the moving average, the green line, that's why you feel like it's bullish now?
Well, I've started looking not necessarily at the daily chart, but I'm looking at the stock as, as a whole overall. It's a very bullish stock, if you can see, and I feel like it fell from grace, and I also feel like it's going to, eventually respect the fact that it's an overall bullish stock. But not only that, like I've been looking at other things on this. I started from the monthly, which is, like I stated, is something that I like to do. I like to look at, the overall sentiment of the stock, and please don't take this as a jump in tomorrow, you guys. If you know how I trade, I like to trade long. I like to get very long expiration dates. So this is something that I'm looking at for, further out, if that makes sense. But what I'm seeing is, potentially going long soon here.
I got you. Thank you.
No problem.
All right, Profit with Ant. You can go ahead and ask your question.
Thank you, Ray. Thank you, Kayla, for allowing me to be on here. No particular question, but would like to see a chart breakdown of something similar to Chewy, since you already did that.
So that's going to take time on the chat. But, we can definitely do that. At some point we can do a breakdown of walking through a trade, but we can't, for the sake of time, do that right now. We have to get through a lot of these questions.
Okay, understandable. Thank you.
No problem.
All right. Oops. Ralph, you can go ahead and ask your question.
Hey, good evening, guys. Thank you for your time. Can you guys hear me?
Yeah, I can hear you. Go ahead,
All right,
Ralph.
my question pertaining to the video you just went over. When we're doing the time frame analysis, we for two to 3 weeks or a month out, just so I'm clear, we should start on a weekly chart
Mm-hmm.
to mark up the chart, and then from there analyze the 4 hour, and then do more analysis and go into the 1 hour. Is that?
So you're looking to hold for a month?
I'm generally looking to do trades between 2 weeks to a month.
Okay. So Ray, how would you do that? Because personally, I'm looking at the entire picture. Whenever I'm taking a trade. So I'm going to look from the 1 year, 1 month. I like to be nosy in a sense, but see, I've been doing this for a minute. I like to see what's going on. I like to see like how they beat earnings. I'm sorry, you guys, how they beat earnings and things of that nature. And then I'm going to go down to the monthly chart, because honestly, that's what you want to see, like how they've been performing month over month. I'm going to scale down to the weekly for my smaller time frame, and then I may enter off of the daily chart. Ray, how would you do that?
1 second before we found great info. All right, I was responding to somebody in chat. Okay, so what was the original question? Like, how would I find it as far as like looking from the weekly down to the daily and stuff like that?
If your plan is to hold for a month,
Mm-hmm.
what would your scale look like? Now, I want you all to know that the presentation is a guide, but you have to develop your strategy on what time frames you want to look at. But it's a guide to show you that you don't have to look at too much detail in reference to going. You don't have to go all the way until the company IPO'd. You know what I mean? You don't have to go that far back. It's basically to give you a guide or parameters to stay within whenever you're deciding to enter a trade. So for example, if you're looking to day trade, you don't have to go and look at a month's worth of data, because that's going to be irrelevant to your intraday trade. Your intraday trade is taking advantages of opportunities that happen within that particular day. So there's no need to look an entire month out. But you also don't want to limit your view as well. You think of it like this. You don't want to look at a book, right, and read one page and think you know everything that the book is going to talk about. You have to have a guide to how much data that you need. So you want to be able to zoom in for enough data and zoom out so that you have enough data to do exactly what you need to do within that trade. But Ray, the question is, how long would you, for your trading strategy, because it's going to vary from trader to trader, how long would you look out or zoom in whenever you're planning to hold for a month? What would be your entry time frame for the month if you're looking to hold for a month, rather?
If I'm looking to hold for a month, my entry could be the weekly or it could be the daily. So let me preface it by saying my strategy is the stretch. So I'm looking at candles. So I would more than likely, if I'm holding it for a month, look at it and see where price is in reference to the quarterly open. And then I'll look at the monthly, then I'll look at the weekly, and I may enter in on the daily if I'm seeing it cross. It's kind of hard. Okay, let me share my chart real quick.
All right, go ahead.
So let me. All right. So boom, share screen. First screen. All right. So for instance, if I was looking to hold for a month, what I would do is I would first look at the 3 month. I might have to delete all this stuff off here. I'll look at the 3 month.
You can hide it. Just hide it with the eye.
I know I just deleted it. I'll add it back in. It won't take long. So I'll first look at the quarterly open. We just had a new quarter. So I'll look at what the quarterly open is in reference to the previous quarter. Then I'll go down to the monthly and I'll look at the month. So to give a quick overview of what the 1, 2, and 3 means, a 1 is basically an inside candle. It's basically a consolidation. It is inside the previous candle. You're always looking at the previous candle in reference to what the candle is now. So I'll be seeing if it's either a consolidation candle or if it's directional. So a 2 down, which is it's a 2 down because it broke the low of the previous candle, or if it would be a 2 up if it broke the high of the previous candle. And then a 3 breaks both sides of the candle. So you can basically look at it. 1 is basically consolidation. A 2 up or 2 down is directional. And a 3 is basically a failed 2 gone 3. So it failed going into one direction, came back through in the other direction. So it broke the high and low. So what I'm looking at is to see, has the month picked a direction? And if it hasn't picked a direction, what may the next month do if we're at the end of the month, right? And then I go down to the weekly and see what the week is doing. So I may enter on the week, but I also may just want to see what the daily is and go down and enter a little bit further. And I know that can be a little bit confusing. If you want more on it, just look at a previous class where I give the breakdown more on it. Also, it's resources in the channel. But that's what I'm looking at. If I'm holding for a month, I want to see what this month is doing and what potentially the next month may do. Because if I'm entering in the middle of a month, obviously I'm gonna go into the next month. So if this month is a consolidation month, the next month might be a 2 up or a 2 down. So you also got to worry about the trend. The trend is always what you're looking at to see, like where is it trending? And you want to pick the direction of the trend that it's going. So if it's trending up, pick something that's going up. If it's trending down, but you are more so worried about calls, then that would be a stock you wouldn't even look at. So you can go back to sharing your screen. Okay. Okay, you heard me?
I'm here. I'm just trying to get my screen back together. 1 second. Anybody else have any questions?
I'm looking through them. Let me see. Well, yeah, I think after Ralph, does that answer fully your question? Like the 2 different methods that we use, it's gonna be based off of your
Um,
um
yeah, I
strategy.
got it. I'm still clearing the fog, but it's making more sense now. I appreciate it.
No problem. All right. So Thomas, you can go ahead and ask your question.
Hey guys, how are you? Thanks for taking my question. Hope everything's going well. I was just curious as to how do you guys establish entry on and if you use any indicators for choosing your leap calls?
I established entries off of areas of support. I personally. Oh, there's a lot of feedback. Can you hear that? Can you hear
Yeah, I muted him for now. I'll unmute him.
Okay. Personally, I like to enter at areas of value. I don't like to enter when a stock is too far from a moving average that it respects. So for example, if you can see my screen, let's just say I wanted to do puts, right? Now, obviously you want to enter into your trade. If you're ideally doing puts, you want to, maybe wait for confirmation of the trend or something like that. But I'm just looking at this chart. I'm not actually charting anything live. I'm just telling you an example of what I mean by it not being too far from an area of value. So right here, I see that, and maybe this won't be the best one. Let's see. All right, so over here we go. I'm gonna do this trade right here. So if I'm in this particular position, I ideally, if I were just to pop up a chart and it was trading around this area right here, I don't care what it's doing. I don't care if it runs, you know, if there is a chance that I missed out on money, I would rather be safe than sorry. This particular stock respects the 9-day EMA. If you see, it typically bounces off the 9-day EMA. It normally rides the 9-day EMA, and I'm on the daily chart, right? So I'm not going to take an entry anywhere in this area. And the reason why is because it has pulled too far away from that 9-day EMA, along with the fact that it's riding the top of the Bollinger Bands, because typically what happens is it's going to come back down and have to respect those levels. So for me, if I'm entering into calls, I may want to position myself somewhere near an area of support, because I know that if I enter at an area of support, not only am I getting a good entry, I'm getting more than likely a cheaper premium as well. And then I'm able to capitalize on the run up. And a good entry essentially means how much money can you make if you enter that trade. If you're entering and it's not near an area of support, then you don't really have a very good area of risk to reward. And that's something that I put out in the community as well. If you're entering into a trade and it's, you know, near an area of, let's see, let's go over here. So let's say you were to enter right here, right? If you're entering and you are not entering at a key level of support or resistance, and you're entering somewhere in this middle point where you're giving yourself an uneven risk to reward, because you may only get this move from, let's say, about right here to, you know, if you caught it and got out in time enough to take this profit, you only get this much of a run up, right? But if it reverses on you, look how much you're losing. That's an uneven risk to reward. So I like to enter into my trades near areas of support and resistance, if that makes sense. And I know Ray has something different because he trades the strat. So Ray.
Huh?
Oh my God.
Bro, people, I'm trying to answer all these questions.
Ray is actually Ray is answering questions within the community, but this is the thing. These support and resistance zones, and they don't even have to necessarily be you know, a horizontal line. They can actually be, you know, your diagonal lines of support and resistance, your channels and things of that nature. The channel didn't draw. But you want to make sure that you're not trading this. I don't want to take this trade right here. It's going to hit this, you know, traveling resistance, if you will. It's going to hit this resistance. I don't want to take it right here. Now, what I might want to do, and again, you guys, I'm just drawing, so don't talk too bad about me. This is ugly. And it's not even doing too many touches. I don't want to do that. But either way, you guys, what I'm saying is, if let's just say there was enough touches for this to be another, you know, bottom line for me, I don't want to take it up here. I want to take it when it pulls somewhere down here, because I want it to be able to have room to go up, so I have enough chance of making profit, if that makes sense. And Ray, that's what he was asking you. He was asking, how would you gauge your entries?
Okay, so I'm gauging my entry based on, so like what I was just talking about. Like if it's an inside candle on whatever time frame I'm looking at, so like let's say I'm looking at the daily, my entry, so like one of my favorite candlestick patterns to play is a 3-1-2. All right, so when the day starts off, if you're looking at it on the daily, it starts off, if it's still an inside candle, I would wait for it to break above that previous candle, which is a 1, to go signal a 3-1-2 reversal. So the 3 would have been to the downside, have been a red candle. The 1 would have been the consolidation. And then the next candle, which would be a 2, it'd be a 2 in the opposite direction, which would be a bullish direction, which means it would be a green candle. So my entry is going to be above that 1 on the daily. So that's how I'm playing my entries. I'll look for a consolidation candle. So if it's doing a 3-1 or a 2-1, I got a script that scans for all that in Thinkorswim. As soon as it break above that 1, that next candle, I'm getting in it I'm getting in that trade. So that's how I'm doing my entries. And so like, let's say I'm looking at it on a weekly time frame, same thing. If it does a 3 or if it does a 2, it might do a 2-1-2 reversal. As soon as it breaks above that one, I'm in that trade. So that's how I'm doing my entries. And that's what I'm basing it off of. I'm basing it off of what the candlestick is doing. And like I said, and which was why I kind of got distracted, my bad, K. They were asking about the scripts and stuff. All that stuff is in Market Facts and Resources in the Wealth Squad. So if you want like how I trade or resources on it, it's in Market Facts and Resources in the Wealth Squad. Also, does that answer your question, Thomas? Because I have
Yeah, absolutely. I really appreciate you guys taking the time.
no problem. All right, so Jamal Hill, you can ask your question.
Hello, can you hear me?
Yeah, I can hear you.
Cool. Well, I appreciate y'all too. Kay, I just watched your course all day yesterday. So my question is this: do you make more money if you buy contracts that cost more versus buying multiple contracts of like a Google or Amazon where a contract is like $1,500? Do you profit more if you bought, let's say, a contract that was worth 100, but you bought like 10 contracts?
Not necessarily, no.
No.
Because if you think about it, you may not be able to buy multiples, and really, it's if you think of it like this: if I were to buy 100 contracts of something that was 30 cents, or which obviously would be $30, I'm still making the same percentage amount on all of those contracts, and I have enough of them to make bank if it goes into the direction that I need it to go in. But if you're buying those expensive contracts, you may not be able to buy as many. So that could be one thing. Another thing is that it could be extremely expensive, but if it falls, it may be extremely volatile and it may fall, several points, and you could lose a lot of money. So no, that's not necessarily the idea at all. I've seen people make, 50, $60,000 off of trades that are, 30-cent trades, which again, it's like a $30 trade. So no. And I'm glad you brought that up while I have you guys' attention. For anyone who's trading with a small account size, or you don't necessarily even have to be trading with a small account size. When you're trading in the stock market, I need you to have the mentality of you going to the grocery store or you going retail shopping for clothes. If you go in there and you say, I'm not spending this much on clothes, or I'm not spending this much on food, you need to have the same mentality with trades. If you see something that gets called out and it's $1, that's $100. You should be someone that's like, I'm not getting in this trade unless it's 30 cents, unless it's 40 cents. Please, you have to treat the stock market the same way that you would treat your everyday life, especially when taking new trades. If you guys understand that, please, for the sake of everything good and holy, please put a 5 in the chat. And I promise you, just taking that simple tip will help you so much, because so many people, the stock market cannot be timed, and nor can we predict what direction, or nor can we say rather what direction it's going to go in, right? But at least this way, it gives you a budget as to what you're trading. And you don't want to exhaust all of your buying power entering into something because you think that it's so expensive that it's going to make you more money. That's not necessarily the way that it goes. It can be expensive and it may not make you too much of anything.
All right. It might move 2% on that contract.
Yeah, and you may not make that much, but something that, I think that's some of Key's best plays when they're like 30 cent, 40 cent trades.
Man.
If you notice, some of his best trades are the really inexpensive ones, So just wait on those,
Facts. Does that answer your question, Jamal?
Yes, sir. Thank you. Appreciate y'all.
No problem. All right, Michael Myers, you can ask your question.
Yes, sir. Thank you for taking my question. Can you hear me?
Yeah.
Yep.
Okay. I just had a quick question. When you're looking at a contract that is like months out, is it okay to take one that is low in volume and how do you gauge as far as your volume? I mean, I did take a few courses, and I try to look at IV like at least a minimum of 200. But I mean, what do you guys say as far as
Hold on, you said
volume?
IV, like implied volatility?
High volatility, yeah.
Yeah, you don't want something that's 200%, bro. That's how you get IV.
Crush.
Yeah, IV crush.
I don't think that's what he means. He's basically saying like if he's looking months down the line, people are focused on right now, right?
Yeah.
Institutional traders that try to look so far out, right? But basically what you want to do is look at historical data. You know what I mean? Try to base it around that particular month and then go back and look historically and see how that stock performed within that time frame. You can look at historical information on Yahoo Finance. You know what I mean? Like, and that's a lot. That's what I like to tell people to do, even if they're trading through earnings. Like, you want to see historically what that company did, previous earnings, but then also look in the previous year during that particular quarter to see how they typically perform. Everything you do in the market to be on the safe side is using historical data. I don't like to trade companies that have reached, new highs unless I'm super confident about them because you have no history on where they can go, which is why I like to trade off of support and resistance lines because it gives me historical information. I know what the stock has the potential to do.
Exactly. And then when you're looking at contracts, look at the open interest and volume. Sometimes there's already people who are way more smarter than us that has already picked a contract on that day where they think it's gonna go crazy or whatnot.
He's saying if it's not a lot though, he's saying like think about elite, Ray. Like if you're getting into a elite contract, there's not a lot of people looking 2 years down the line. So I think he's meaning like.
Well, yeah, sometimes it's not, but like I don't know if you did it before, but like I'll look at it and I'll just like, so what I do when I'm looking at contracts is because I like to pick out the money or right at the money, I'll look through all of them and see where the most open interest and volume is on that day or on that expiration for those contracts. Also, like sometimes like if you use Flow Algo, there'd be like a sweep for elite. So that may bring my attention to it, stuff like that. But what you were saying, Kay?
Oh no, that I think that the thing when you're looking at leaps, because I love leaps, is that you always have to also consider is this number one, psychological levels. Traders like to trade off of whole numbers. So keep that in mind, especially when you're dealing with leaps. Like you just have to trigger and train rather your mindset to think a different way. So you have to think what would make this trade go right. So number one, maybe look at, whole numbers. Number two, also think about the fact that maybe people aren't looking at it right now because it's not right now. But as time goes on, more people are going to, because that's the contract that's going to be available as time goes on. So that's why I say use historical information. Just make sure that the stock has the potential to reach that particular amount in the time frame that you're looking, and you should be fine. Hopefully.
Okay. Yeah, I apologize because I used the wrong terminology. I meant open interest of 200, not implied volatility.
No problem.
So I didn't want to confuse you guys, but I appreciate your help.
No problem.
All right, Liz, you can go ahead and ask your question.
Yes. Hello. Hi. One, thank you both for taking the time out and making sure.
Are you there?
Liz, can you? It kind of seemed like she went out.
Yeah, she did. We can circle back if anything.
All right, yeah, we'll circle back to her. That's weird. Hold on 1 second, Kay. No, I ain't gonna do it. All right. Kieran, you can go ahead and ask your question.
How you guys doing?
How are you?
Pretty good. So I kind of came up with this weird strategy, like over the past like month or so. Like I've seen certain stocks drop like astronomically. Like if you look at like how Discovery like randomly dropped out of nowhere, and it hit like some crazy lows from when it was at like 60. So I bought a contract like right when it hit that bottom within the week, and like within the day it went up just because people see like that it's dropping super low, so they want to get in, and it goes up like 400% or so. I've used this for a couple other ones like Tupperware and Celsius, but I was wondering if you guys have like any info on like that type of like scalping.
I'm not even gonna lie to you, I did not understand.
For real?
Yeah. Now, what was your strategy?
So wait, would you mind pulling up the DISCK chart?
Was actually DISCK or A? Discovery?
K.
Okay.
So basically when it hit that huge drop from like 70 to 35, I bought the contract at 35, but I bought one for like June at $28 as the strike price. So like really cheap. Like I only put like 45 into it, but it within the day it went up like 400%. And I mean, I didn't sell. It's my bad. But
No, okay, so I know exactly what you did, right? So more than likely when you purchased that contract, it was trading below all moving averages. And then you purchased a January contract for what, 2022?
No, I purchased
I think you
it
said
for
June.
June 18th.
For June, okay. Either way, you purchased a skip. Consider that a skip, right?
Okay.
So the reason why, think about it like this: you purchased a valuable stock. This is Discovery. You purchased a valuable stock, more than likely below all moving averages. You gave it time on your expiration date. I'm not sure what your strike price was, but I guarantee you, whatever it was, it has a high chance of hitting that particular mark by June. So
Yeah, exactly.
that is something I practice that particular strategy, but essentially all you're doing is you're looking for a valuable company that's trading below all moving averages. Even Gerald Peters talked about this. You basically found the bottom of something that is valuable. Those are trades you like. Those are trades I take religiously.
Yeah, so like I woke up that morning and I looked at the market and I was like, what the hell? It dropped so much. Like it was damn near like a 50% decline. And it's an S&P 500 stock. So I was like, there's no way it's gonna stay at that level. I mean, it kind of has, but I was like, so I set the strike at 68 because that was basically what it was previously. So,
That is absolutely a strategy. That is a strategy that I learned when I first started trading. And to be honest with you, for example, I'm in a trade right now, which is XLK. I bought XLK at $11.94, which is $1,194. And I bought a couple of those or a few of those contracts, and they expire in January of 2023. But if you guys have followed, and I'm not even going to mention it, but anyways, if you trade leaps and you find valuable stocks, meaning stocks that you know have been around and are not going anywhere. For example, an airline, if you see airlines fall, unless it was the pandemic, because it took quite some time. But if you see something below all moving averages, especially on longer time frames, and it's a company you know it's not going anywhere, obviously you want to wait for signs of reversal. But please keep those on your watch list, because those are ones that will make you money.
definitely. Thank you so much.
No problem.
All right. And Kay, can you speak up some? Your mic is weird.
Oh, I'm sorry.
All right. RR, you can ask your question.
Hi, I'm new to this. I really don't know what I'm doing, but my question is it better to do options or just buy shares and hold on to it?
That depends on your particular lifestyle. And I say that as a single mother, that depends on what type of time and patience you have and your risk tolerance. When you're trading shares, you are spending more money, but you have less risk, because think of it like this: if you were to take, for example, this stock I'm looking at right now, if you were to buy this particular stock at $40 and it dropped down to $10, you still hold that position, so you can hold it and hope that it rides back up, right? However, with options, you have less capital that you're spending or less money that you're spending, but you have more risk because options are tied to an expiration date. So if it doesn't do what you want it to do by the expiration date, you've essentially lost everything that you put in.
So if I buy an option with the assumption that it's going either direction, whatever I buy, the put or the call, and it goes against it, but I have an expiration date, let's say for 6 months from now, what, and I just write it out and then I wait until, let's say I did the call and then it does go up, but in the beginning it did go down, but then eventually it goes up before my expiration date. I can take out my gains then. I mean, wishful thinking if it goes my direction, but I can just hold on to it and then I can just sell once it goes up and I profit whatever percentage I'm willing to take, right?
Exactly. Yes, you can.
Okay.
Now that's
Okay.
perfect market that you know that happens, but you always have to, you know,
Think of the Greeks and everything else that goes in between it.
it's so much to it. So yes, so in the long and short of it is that buying shares is less risky, but it costs you more money. However, trading options costs you less money, but it's more risky. That would
Got
be
it.
Yeah,
Okay. Thank you so much.
no problem.
All right. Charles Miller, go ahead and ask your question. Charles Miller. All right, we'll just go around. Celine Davis, since you were trying to ask earlier, what's your question?
Hello, can you hear me now?
Yep.
Perfect. Okay. One, Kayleen.
Oh,
Two,
sorry.
no, it's okay. You wouldn't know. Thank you guys for all the information that you've been giving us. I've been following for a while, but I never had the time to really like pay attention. So now that I have the time, I'm gonna start like looking at the different books and courses I've purchased from some of the providers. But a very kind of beginner question, when you're looking at these charts, and I'm seeing specifically the trader view, as someone who's just beginning, what would be the best like paid or free charts so that I could actually start seeing these things and like putting my indicators on? Because I don't know where to jump in, and I'm the type who wants to buy everything, and I'm like, let me just focus on one so I can learn that and then go forward.
I definitely would say just utilize the free version in the beginning. You know, you need more indicators as you go along. You know what I mean? I don't think that you have to necessarily have all the indicators in the world when you first start trading, and they give you a few free ones in the beginning. And then not only that, you can use the matter of fact, let me just say it like this. So for example, I'm using, and even though I'm on a paid version, I don't know, I just still have this stuck on my chart, but this right here is something that another trader created. They have their own little, you know, scripts or whatever, where they give you free indicators, right? You can search what you want and still use like them for free. So for some reason it won't activate, but I'm using right now the 4 EMA plus the Bollinger Bands. I would have had to use the EMA separately and the Bollinger Band separately if I would have just, you know, went and searched it, but you can actually search what you need and see if somebody has already combined them for free. So that's a cheat code for you.
Thank you.
No problem.
All right. Richard, you can go ahead and ask your question.
Hey, can you hear me?
Yes.
Yep.
All right, cool. My question is, can you explain implied volatility?
Yes. That basically is, think of the word implied. That's the consequence around a stock doing something by a particular date if you're thinking of the stock market. So implied volatility is basically going to be, let's say an earnings date, or maybe, you know, Jordan is releasing a new shoe and Apple is releasing a new phone. The implied volatility is the suspense around that particular event, which is factored into your options contract. What happens is once that event happens, the suspense is gone. It's no longer there. So the value of your contract may actually decrease after that suspense is over, unless, you know, there is some significant news with that particular stock. So you don't want to get into contracts that have extremely high implied volatility, because when it falls, again, you have a very uneven risk to reward. So that's my take on implied. It's just the suspense around something happening on a particular date or time frame that traders are looking forward to.
Okay. One more question. I'm sorry. What percentage should you be looking for when you're getting into option contracts?
So, I mean, you can see implied volatility get up a few hundred, 100%,
Yeah.
and so I can't give you a percent as to where it's going to collapse at. But what I will say is I don't get into contracts that have, implied volatility in the high hundreds or even the high tens, like, 90, 80, 90%, I don't touch those. I'm trying to stay at the low 10 factor, like 50, 60, somewhere around there.
Okay.
But not in the high hundreds and things of that nature. There is no set number that I don't think anyone can give you.
Okay. One last thing. What indicators do you rely on in your day to day?
What I have on my chart is, and I am an indicators girl, but sometimes I like to look at price action too.
Okay.
For example, on my chart, I have the volume. I like to see the volume. And I've touched on this in a previous video, but I'll do it again. Here, I have my volume indicator. I also have the moving average turned on my volume indicator. I have the Bollinger Bands.
Okay.
I have my 4 exponential moving averages based upon, how I like to view them, which is the 9, the 21, 100, and 200. I have my volume weighted average price, my MACD, and my RSI. Now, I don't necessarily need all of those, but it depends on like what type of confirmation I'm looking for. I may not, use my Bollinger Bands. I may not. I'm definitely going to have my RSI and my MACD.
Yep. Okay. So say you have 8 indicators up, right? And you're trying to get into a trade. How many of them will give you confirmation? Like 2 out of 3, 2 out of 8, 4 out of 8?
I honestly need 3, and I'll be good. And I know Ray, he trades as a strat. He doesn't use indicators. So this may be for some people. This may not be. I'm more of a momentum trader. If I am doing momentum trading, so I trade the orb strategy. And then I also I like longer term expiration dates as well. So my strategy is to go long. And so this is what helps me. But you may have a different strategy. You may be a day trader. You may trade the strat. You may trade off of Fibonacci levels. It just depends on what you find comfortable. So I would encourage you to just paper trade.
Yep.
And see what works best for you.
Yeah. Only reason I'm asking is just because, I work a 9 to 5. And I'm trading off my phone. And sometimes I'll see a call and I'm like, I'm not sure. Like, it doesn't line up with what I'm working with.
Right. So my recommendation, because if you guys saw when I put it in my bio, I work a full-time job and I have been for 13 years. And I love the company and I love to work, so I'm not leaving. And I love the insurance.
Yeah, I'm working, I work for a utility company. So I'm like always, using my hands. So
you can't watch the chart. So
yeah.
What I would recommend for you is to trade with long expiration dates. That way, and this is for everyone, single fathers who have, children, single mothers, people who are busy, every single day. My recommendation to you guys is if you want to trade, you don't have to get into short expiration dates. Go long. That way you have less IV crush. You have less theta coming out of your contracts. You have longer expiration dates, which gives you a chance to recover if the stock reverses on you. So my recommendation would be to go long. Again, you guys, you can make a lot of good money going long. Like I stated, I'm in a contract right now that I bought a few weeks ago, literally maybe 2 or 3 weeks ago, that I purchased for, each contract was $1,194. Right now, each contract is probably $1,600. So just that quick. And if I wanted to take my profit right now, I literally could. So you don't have to get the super fast gains every single day. You can go long and have a value company and make what you could potentially make off of day trading with less risk, to be honest with you.
Okay.
So keep that in mind.
All right. Thank you very much.
No problem.
All right. We're going to take 2 more questions. Let's see. D Jacob, you can go ahead and ask your question.
Thank you guys for taking the time to help us learn this stuff. When you were going over your PowerPoint presentation, you went over, I can't remember what it was, but you asked us to put fives in there if we understood it, and a lot of people did, some of us didn't. I just wanted to know if you could, and you said we could circle back on it. If you could circle back on that using, showing us the chart, explaining it. It was, go back down. It was this thing.
I know exactly what you're talking about.
Yeah. Could you like just talk about this a little bit, but
Sure.
doing it, showing the chart?
Okay, so basically this is a particular trader's trading strategy. So again, our goal whenever we do these lessons is not to give you guys a concrete set in stone way of trading. We're just here to guide you because there are so many strategies out there. Not even me and Ray know of all the strategies, and there are so many emerging as well. So
Right.
this particular strategy is from, like I said, Dr. Alexander Elder, where he talked about the factor of 4 to 6. So it basically means you don't need that much information to be successful, and you don't need this, and it's going to be in the Wells Fargo University, but you don't have to zoom out so far to see information where a company IPO'd to be successful in a trade that you want to enter into right now. So it basically means that once you identify whatever your entry time frame is, simply multiply that by 4, 5, or 6. But keep in mind, if you multiply by 4, 5, or 6, you have to go off of what your stock, your particular trading platform gives you. So for example, if I'm going to be entering off of a 15-minute chart, if I multiply 15 by 4, that means that the higher time frame where I would get my data from would be the 1 hour chart. So for example, okay, let's go here. Let's just say I'm entering off of the 15-minute chart off of BABA. You guys, I am still in the process of charting BABA. So again, I say this because whenever we talk about a chart or put a chart out in the community, people jump in immediately. And what we're doing is we're saying we're watching this so that we're positioning ourselves at a prime entry to make money. But so many times people enter into stuff and like, oh, it dropped. And we're like, it wasn't time to get in yet. So let's just say I wanted to enter into this particular trade, BABA, and I'm looking at an hourly or a 15-minute would be my entry, right? This is the data that I need to intraday trade. I don't need to go down to the 1-minute chart. This is the purpose of that, is to say you don't have to look at too much information that can confuse you. I don't have to look at this. This would confuse the heck out of me. I wouldn't know what to do, if that makes sense.
Yes.
I would look at, and this is a lot of noise. You would get shaken out right here, right? You would be like, oh my God, it's dropping. But look, it went back up, right? This is, every candlestick represents 1 minute on this 1-minute chart. Let me make sure I'm on the 1 day, 1 minute. 1 day, 1 minute. This is just hectic and crazy. You know what I mean? So I was on the right thing. Let me go back over. So for example, what I'm saying is my higher time frame, if I'm going to be trading off of the 15-minute, meaning that I'm getting in my position off of the 15-minute, then the highest that I may want to look at would maybe be the 1 hour or at best the 2-hour time frame. I don't need to go all the way to a week because a week's worth of data isn't going to give me what I need to intraday trade. It's unnecessary. It's too much information. Right. All these smaller candlesticks are going to mix. So for example, when you're looking at a weekly time frame as your longer time frame, then the daily chart, all of these candles, if you take a week's worth of candlesticks, right? If you take a week worth of candlesticks, it's going to represent on a weekly chart just 1 candle. So I don't need to go down to a minute or 5 minutes if I'm planning to hold for 2 months or 3 months.
Oh,
so that's what it basically means. It's basically saying how far do you need to view on a smaller time frame versus a larger time frame to do what you need to do based upon whatever your plan is to trade. So hopefully that didn't confuse you.
No, that makes sense now, but
Right.
at first it didn't. But I do have one other quick question: is there a point that you ever use the 1 minute chart?
Um,
Because I mean, it's always
I
like, don't use 1 minute chart.
do
Huh?
as not as I do, but there have been times when I have been day trading where I may look at, the 1 minute chart, because in my head I'm counting candles. You know what I mean? I'm
Okay.
like, all right, 1, 2, 3, 4. The next 5 minute candle is gonna be bullish. That's how I'm thinking, right? So
Right.
so I'm doing that. Now I don't recommend it, because if you are somebody who is developing patience with trading, something like that can make you lose your position, where this 5 minute candle, if this were a 5 minute candle, it was bearish, but then right after that it was bullish. So just that quickly you could have gotten shaken out. So that's what I mean. Like, I don't personally recommend watching the 1 minute channel. It's a bunch of noise. It's a lot of noise.
I know. I think I use it a lot.
Yeah, it's a bunch of noise.
And you're right. I sit there paranoid watching it. So I need to stop.
A 5 minute or maybe even a 15-minute chart encourages more patience and won't shake you out of your trade.
Okay.
And then
Thank
you need
you.
to see key levels as well when you're day trading. You see what I'm saying? So if I were to put you on a 1 minute chart, you can't really see key levels because it's bouncing so much. It's like, where are your key levels? But if you go over to a 15-minute chart, or maybe like I can easily see a level. I can easily see levels when I come over to this chart. If I go over to a 1 hour chart, I can easily see my levels that I need to draw, if that makes sense. Right here, I see a resistance right here. It's respected. It's going straight across. I see that immediately. So that's why it's important to look at, a little bit longer time frames.
Right.
Okay.
Okay. Thank you.
No problem. And the last question.
All right.
This one over today.
Sandra's iPhone.
Sandra, this your moment. What's up?
If not, well, she popped down. All right, Jerry, you can Downey, you can go ahead and ask your question.
Ooh, bet. Right. Appreciate that. Can you guys hear me?
Yes.
Okay. So my question kind of has to do with like the fundamental side. It was kind of like, yeah, I know you explained like FinViz and stuff like that, but when you go to actually sit down and like create your watch list, like other than just looking at like the sectors and using FinViz, like is there anything else you do at all? Because like sometimes I feel like there's like something missing. And also, like in the current options ideas chat, like intraday, like I'm looking at it right now. I'm just gonna pull up an example. Chris like mentioned TDOC in the middle of the day, and it's like, how do you even like come up with like that ticker like intraday? Like, how do you know what I'm trying to say? Like,
it may have
how
gotten
how do you find plays like in the middle of the day too?
It may have gotten alerted by whatever screener he's using. I think he uses Flow Algo. Does he use Flow Algo? What is his name? Lord Ray. Does Chris uses Flow Algo, right?
Yeah, he uses Flow Algo from my understanding.
So if you have an advanced screener, I use Flow Algo. Or do I use? Yeah, I use Flow Algo and I use FinViz. So there are paid platforms that show you where institutions are placing their money, or large orders are being filled at. So if he sees that, that may be an indicator for him to say, okay, maybe this is worth looking into right now. And if it is, then that may be a trade that he may post. Not only that, it could be maybe he's been watching something, or maybe it's something that's getting ready to report earnings, or maybe something hidden indicator on his chart. Like, for example, you can actually, like if I wanted to, I could set an alert for something that may hit, you know what I mean? A particular level on my chart, and it may buzz me and say, okay, time to look at this. It's hitting a key level for you. So that may be what's happening on his end. Does that make sense?
Oh, let me unmute him. Jerry?
Yeah, that makes sense. Thank you so much.
No problem.
Also, is Flow Algo like worth it though? Like, I don't have it. I use TradingView and I use FinViz already, but do you think like Flow Algo would be like money well spent? Like, does it help you a lot, like personally?
To be honest with you, you can be successful with, a screener that you don't have to pay for, but when you're using Flow Algo, you get to see a whole lot more. So for my personal opinion, I would say yes, Flow Algo is worth it, but I don't even use it every single day. You don't necessarily have to have it, but it definitely is worth it. And I was trying to show you guys how to add an alert. I was clicking on the wrong thing, but for example, if I wanted it to hit, if I wanted to be alerted when price action hits this line, I can simply set an alert, and then if it hits that line, I'll hear it, and then I'm able to jump over to my chart and be like, all right, so this is probably time for me to take this trade. So that could be something he's doing as well, which is why I tell you guys, whenever we put a chart out there, if we're saying it needs to break a key level in order for us to enter the trade, this is exactly what we mean. We don't mean, hey, we put a chart out here, go jump in right now. No, because you can lose money. So that is what we mean when we put those charts out there.
Okay, cool. Thank you so much.
All right. So I will also say this. Sometimes you will be shaken out of your trades and stuff like that. Like I've been shaken out of trades. I haven't caught the full swing of a trade. So sometimes it will happen. But if you're used to taking 20 to 30% and you've gotten good enough to where you're confident to stay in the trade more, stay in the trade longer if you feel that you're confident enough, if it's still showing the indications that made you even get in the trade. Because sometimes you'll miss out on money and sometimes you won't. Sometimes you got out at the right time, right before it took a dip or it reversed on you, went completely in the other direction. And always remember, you can always re-enter the trade when it's reversing back into your direction after a minor dip. Like for instance, K, right there, pause, don't move anything. I'm finna show a perfect example of if it let me annotate on it. I don't think it's let me annotate on it. But like right there, get like a horizontal line. So you see where you started your channel at the bottom?
Yep.
All right. You see that little direction, like right above that? That's what they like. If you can mark across that top, that's a triangle right there. So that's what I mean by TTO, triangle layouts. It will come down. Now go up to where you started the top line.
Oh, okay, right here. My triangle.
Yeah.
Okay,
That sometimes, yeah, it will form a triangle. You can see where the dotted lines are at. It will form a triangle and triangle you out the trade before going to the upside. It actually did it twice. So that's what I mean by TTO, triangle layout. So sometimes you will get shaken out of a trade for it just to go back up. So those are like the minor triangles they will form before going to the upside. And you will see that on a lot of charts. And that's what that dip that they call, that's the dip. So it knocks some people out of the trade to the upside, then comes back through the trade, knocks out the people that were short. So that's a TTO. That's a triangle layout. So if you see me say that, that's what I'm looking at. That's what I'm seeing. And those little pullbacks, as they call them, or triangles that they form, will knock you out the trade. And sometimes it'll happen, but you can always re-enter when it goes back in the direction that you want it to go to. So outside of that, let us know in the option chat how much you appreciate the class. You know what I'm saying? Shout us out, tag us, whatever. We appreciate y'all for tuning in.